You've got $100,000 sitting in your account. What you do with it next could be the difference between retiring at 55 or grinding it out until you're 70. This is the great Australian debate. $100,000 in stocks versus $100,000 in property. Today, we're settling it with real numbers. Let's start with stocks because most people underestimate this option. Drop $100,000 into an ASX 200 index fund, and history says you'll earn roughly 9 to 10% a year once you include dividends. And here's what makes the Aussie share market special. Franking credits. Because Australian companies have already paid tax on their profits, you get a credit that boosts your after-tax return. So let's run the numbers. $100,000 compounding at 9% grows to about $236,000 in 10 years. Stretch it to 20 years and you're sitting on around $560,000. No mortgage applications, no tenants calling you at midnight because the hot water system blew up. You just bought the fund and let compounding do the heavy lifting. And if you drip feed an extra $500 a month on top, over 20 years, that's well over $900,000. But here's where the debate flips, because property investors have one weapon that stock investors don't: leverage. With $100,000, you don't buy a $100,000 property. You use it as a deposit and buy something worth $500,000. The bank lends you the rest. So your $100,000 is now controlling a $500,000 asset. Australian property has historically grown about 6 to 7% a year. That sounds lower than stocks. But hold on, that growth isn't on your $100,000. It's on the full $500,000. So a 6% rise in year one adds $30,000 to your net worth, not $6,000. That's a 30% return on your actual cash. A $500,000 property growing at 6% is worth about $895,000 after 10 years. Over 20 years, more than $1.6 million, and you've been collecting rent the whole time. But property has a catch most people forget: entry costs. Stamp duty alone can run $15,000 to $22,000, and once you add conveyancing, inspections, and lender's mortgage insurance, you can burn $25,000 to $30,000 of your $100,000 before you even get the keys. With stocks, your entry cost is basically zero. So which one wins? Here's the truth: they have completely different strengths. Stocks give you liquidity. You can sell shares on a Tuesday and have the cash by Thursday. One index fund, and you own a slice of 200 of Australia's biggest companies. But property gives you control. You can renovate, raise the rent, add a granny flat, and force the value up. With an index fund, you're a passenger. A well-rewarded passenger, but a passenger. And don't ignore the environment. The Reserve Bank of Australia cash rate is sitting at 4.1%, so borrowing is expensive right now. Stocks don't care about interest rates, they just keep compounding. But high rates often push property prices down in the short term, which means if you've got cash and courage, you might be buying at a discount before the next cycle. There's also a psychological truth nobody admits. Most property investors actually stick with it because the mortgage forces them to. You cannot panic sell a house at 2 in the morning. But with stocks, one bad headline and people sell at the worst possible time. Sometimes the best investment isn't the one with the highest return. It's the one you'll actually hold long enough to let it compound. So here's the real answer to the $100,000 question. If you want simplicity and low maintenance, stocks are incredibly hard to beat. If you want to accelerate your wealth using other people's money, and you can handle the complexity, property can deliver return stocks mathematically can't match. But the real winners do both. They build a share portfolio for liquidity and compounding, and they use leverage to grow property alongside it. That's how generational wealth is actually built in this country. If this helped you think differently about your money, smash that like button and subscribe. Thanks for watching, and I'll see you in the next one.